Today, we delve into one of the most critical geopolitical and economic developments of our time, the U.S. airstrikes on Iran. We will analyze their profound implications for global oil markets, inflation trajectories, and the escalating risk of a worldwide economic recession. For investors, understanding these dynamics is paramount for strategic portfolio positioning. Over the weekend, the U.S. military launched Operation Midnight Hammer, deploying advanced B-2 stealth bombers and submarine-launched Tomahawk cruise missiles. These precision strikes targeted multiple Iranian nuclear facilities, marking a significant escalation. President Trump described the outcome as the complete and total destruction of Iran's uranium enrichment capabilities. Iran, however, swiftly vowed not to abandon its nuclear program, warning of severe and long-lasting consequences. Foreign Minister Abbas Araghchi stated that Iran reserves all options to defend its sovereignty, interest, and people, calling the attacks outrageous and warning of everlasting consequences. This immediate and defiant response signals a prolonged period of heightened regional instability. Such geopolitical friction inherently introduces substantial uncertainty into global economic forecasts. In a direct and potent countermeasure, Iran's parliament approved a motion to block the Strait of Hormuz. This narrow, 21-mile-wide waterway is a critical maritime choke point, through which over 20% of the world's total oil supply, alongside significant volumes of liquefied natural gas, LNG, transits daily. Its strategic importance cannot be overstated. Market sentiment immediately reflected this heightened risk. According to Polymarket Betting, the odds of Iran effectively closing the Strait of Hormuz in 2025 surged dramatically. They rose from below 20% in early June to over 50%, indicating a significant repricing of geopolitical risk by informed participants. While Iran cannot physically close the strait like a gate, it possesses various asymmetric capabilities to make passage prohibitively dangerous. This includes mining operations, missile threats against commercial vessels, or persistent harassment of oil tankers. Such actions would lead to severe shipping delays, soaring insurance premiums, and ultimately, dramatic price spikes for energy commodities. The immediate market reaction was a sharp surge in oil prices. Brent crude, the international benchmark, saw its second-month volatility spike, reflecting increased uncertainty and speculative activity. Furthermore, option markets exhibited a strong skew toward upside calls, signaling that sophisticated traders are actively hedging against, or positioning for, much higher oil prices in the near term. This indicates a significant risk premium being priced into the market. Should the Strait of Hormuz be effectively disrupted, the economic models suggest crude oil prices could easily double from current levels. Historical analysis indicates that even a 1% supply disruption, given the inelasticity of global oil demand in the short run, can trigger a price increase of 5% or more. A sustained disruption would have exponential effects, rapidly depleting global strategic reserves and exacerbating supply fears. History offers a stark warning: when oil prices double year on year, it frequently precedes a global economic recession. Over the past 5 decades, nearly every major U.S. recession has been either directly preceded or accompanied by a significant oil price shock. These shocks act as a regressive tax on consumers and a cost burden on businesses, stifling economic activity. A sustained spike in Brent crude towards $120 per barrel would bring its annual gain close to 100%. Such a rapid and substantial increase would significantly elevate the probability of a U.S. and global recession within the next 12 to 18 months. This scenario would erode consumer purchasing power, increase transportation and manufacturing costs, and compress corporate profit margins across various sectors. The prospect of a new oil shock presents central banks, particularly the U.S. Federal Reserve, with a pressing policy dilemma. Global economies are already contending with persistent inflationary pressures, partly driven by U.S.-imposed tariffs. A renewed surge in energy prices would likely intensify these pressures, raising the risk of stagflation, a period characterized by high inflation and sluggish economic growth. Central banks would be torn between two conflicting objectives: cutting interest rates to support flagging economic growth and prevent a deeper recession, or maintaining a hawkish stance to contain spiraling price pressures. This policy tightrope walk increases market volatility and complicates investment strategies. Investors must prepare for potential shifts in monetary policy that could impact asset valuations across the board. For investors, this evolving situation calls for careful assessment and strategic foresight. Portfolio diversification, especially into sectors resilient to energy price shocks and inflation, is essential. Commodities with strong supply-demand fundamentals, such as gold and silver, may serve as effective hedges against inflation. However, a broader economic slowdown could weigh on equity valuations. Consider re-evaluating exposure to energy-intensive industries and consumer discretionary sectors, which are highly sensitive to rising fuel costs and reduced consumer spending. Conversely, defensive sectors and companies with strong balance sheets and pricing power may offer relative stability. Risk management, including hedging strategies, should be a priority in this volatile environment. To summarize our economic analysis, the U.S. strike on Iran has dramatically escalated geopolitical risks, directly impacting global economic stability. Iran's credible threat to the Strait of Hormuz poses an existential risk to global oil flows, with cascading effects. Oil prices are poised to spike to levels historically associated with severe economic recessions and market downturns. Central banks face an unenviable policy dilemma, potentially forced to choose between combating inflation and supporting growth, increasing stagflation risks. Backhand index pointing right. If you found this in-depth economic analysis valuable for your investment decisions, please like this video, subscribe to our channel for more insights, and share it with your network. Your engagement helps us deliver critical market intelligence.
Thanks for watching. That's all for today's update. Don't forget to like, subscribe, and hit the notification bell for more in-depth market analysis. See you next time.